Welcome, everybody. Thanks for joining us. My name is Kristen Biermeyer. I'm the marketing manager for Wagner CPAs, and I'm so happy that you're all here today for our accounting and audit update. The presentation is being recorded today and will be emailed to you after today's event, along with the PowerPoint slide deck. Feel free to submit any questions you have during the webinar using the Q&A feature that's at the bottom of your screen, and Kyle will be addressing those questions at the end of the webinar. Our presenter today is Kyle Ager, a senior manager in the assurance department at Wagner CPAs. Kyle is devoted to serving nonprofit clients with their audits and reviews and 990s. With that, Kyle, I will turn things over to you.
Thank you. Thank you for the introduction. Just to expand just a little bit, I've been at Wagner for about over 10 years now, specializing in working with nonprofits. And based on looking at the attendee list, I've worked with many of you over the years. So it's great to have you all on the call, and welcome again. The goal for today's webinar is to identify some new developments in audit and accounting guidance that will be affecting the nonprofit industry. Today, we'll be covering some new auditing standards and what they mean to you, some new accounting standards in effect for 2022, the gifts in kind standard and the lease standard, and then just some updates on COVID-19 funding. Many of the examples and flow charts that I'll have on the screen today are from the AICPA, so I just want to give them credit for some of the tools that we're using. And then you might have noticed the picture of Grover I have on the screen. This is from the children's book, The Monster, at the end of the book. And I think that many of us have thought of the lease standard kind of like the monster at the end of the book that none of us really wanted to get to, because it's kind of a big, scary topic. But my goal specifically with the lease standard is to break it down into some of the easier components. And hopefully at the end of the presentation today, we'll all see that there really wasn't anything to be afraid of, just like in the book. We're going to start out with the new auditing standards. There's just a couple of them that we'll discuss. There's also some new standards coming up for reviews and employee benefit plans and agreed upon procedures, but those are not going to be covered for today. So we're going to jump right into SAS 142 for audit evidence. This is in effect for 2022. It's a very principles-based standard. There's not a lot of new procedures that the auditors will need to do. It's really an attempt to modernize audit evidence. And a big cause for this is that just the big changes in technology. It's certainly a different world that we're auditing in now compared to even 5-10 years ago. So much is electronic now. Everything used to be paper-based, and now we're using online tools and sharing files online and looking at bank statements and investment statements and PDFs. So a lot has changed just with technology. And with that, there's a heavy emphasis on gaining an understanding of IT controls. Next, we're going to talk just for a moment about SAS 145. This is in effect for 2023. And a big part of this standard is evaluating internal controls. Specifically, we're going to be evaluating primarily direct controls, and also, again, building upon our understanding of IT controls. There's some new terminology in this standard, like the direct and indirect controls. And as your auditors, we'll be focusing on walkthroughs of significant direct controls. So now we're going to jump right into the accounting standards that are effective in 2022. And the first one is the gifts in kind standard. This is in effect for all December 31st, 2022 year ends. And it was also in effect for June 30th, 2022 year ends. So if you have a June 30th year end, you've likely already worked through much of this with your auditors or accountants already. The goal of this standard is to increase transparency about contributed non-financial assets. And those specifically are things like fixed assets, materials, supplies, services, and they do not include things like donated stock, as those would be called a financial asset. This standard requires retrospective application, So if you're presenting both years in your financial statements, we'll need to make those adjustments to the previous year as well. So why is transparency important with in-kind contributions? If the level of the in-kind contributions you had decreased, your organization would need to choose whether or not to spend more resources to make up that difference or to scale back in your programs. So having this extra transparency really helps the users understand how your organization is being funded. So this is mainly a presentational standard. It does not change the way that the accountants are doing their day-to-day recording of the in-kind transactions. A big change is that we'll show on the next slide is that we're going to show those contributed non-financial assets on their own line on the statement of activities. And then with the footnotes, we're really going to enhance the disclosures compared to what we had in the past by showing the types of asset or non-financial assets that you've received, how they're being used, and if they're restricted, and also how they're valued. So we'll have some examples of those on the next slides. So here, the only thing that we're going to do is just highlight that new line on the statement of activities. The wording might change a little bit depending on the organization and how they want things to show up. But essentially, there's going to be a new separate line on the statement of activities to show those in-kind transactions. In the footnotes, we just have some examples here for you. You can see in the first little table, we're showing the different types of the in-kinds that an organization might receive. Next, we're going to describe how those in-kinds have been valued. There's many different approaches depending on the asset. We're also going to describe in the next paragraph if those assets were restricted for a certain program or purpose. And then also we're going to describe the programs that those assets were used in. This is just a list of some in-kind transactions that organizations might have and might not necessarily think about. The only thing I'll say is if you think that you might have some of these and you're uncertain if they've been recorded in the past, just check with your auditor and they can help you determine whether or not those ought to be included in your financial statements. All right, so now we're going to talk about leases. This is in effect for the first time for nonprofits for calendar year December 31st, 2022. And the biggest change that you're going to see with this standard is that most of the leases will now be recorded on the statement of financial position as both an asset and a liability. The thought process behind this is that assets are a future economic benefit, and liabilities are a probable sacrifice of those benefits, and they really feel that that leased asset meets both of those definitions. This is a really long and complicated standard. It's over 500 pages long, and there's a lot of lots of examples and complicated situations that might arise. However, we're not going to go into those complicated examples. I think the best thing we can do is think about simple leases and then build slightly upon that. This standard really is going to affect, I think, a lot of nonprofits, as many of them are either leasing space or potentially leasing a copier or something like that, or some other type of asset. So this slide here notes some of the experiences from some public companies that have adopted the standard in previous years. And for each item, I'll run through them really quickly. And then I'll also have kind of a rebuttal for why I hopefully don't think that these are going to be that big of a deal for many nonprofits. I'll also say that when I talk about some of these policies and things in elections that nonprofits can make, there's going to be a pro and a con associated with each policy and the way that you choose to move forward. However, we're going to help with some recommendations, and I really don't think that the cons that we'll be discussing are really substantial for most nonprofits. To put it in kind of a humorous way, I think that we'll be looking at a situation like if we eat too much cake, we might not have any room for broccoli. So we'll go through each of these just really quickly. The compliance with contractual agreements and loan covenants, I really don't think that this is going to be a big deal. So the idea is that with these new assets and liabilities, that loan covenants might be effective for things like current ratios or debt to equity. And from conversations I've had with bankers, they're really not interested in seeing their banking clients be out of compliance with their loan covenants. What they've told me through many conversations is that they plan to either follow prior GAAP and calculate the ratios as the same way that they've done in the past, or come up with a new ratio or something like that that seems fair under the circumstances. The remeasurements for assets will come up whenever a lease potentially changes, maybe like the term or the assets that are being leased. We'll cover this later in the presentation, but this is definitely something that we're going to want to keep our eyes on moving forward. Whenever a lease changes, you'll want to be letting your accountants know on an annual basis so they can help make sure that those calculations are updated correctly. Segregating between lease and non-lease components. Leases have different components, such as like a service component if you're leasing something like a copier. And the standard does give us an option to combine both lease and non-lease components. And I think that most nonprofits are going to do that. So that one I'm not as worried about either. The incremental borrowing rate is maybe a term that you've heard in association with the standard. It can be complicated to come up with that rate. And I don't think that this is going to be a big deal either, as nonprofits can use a risk-free rate, which we'll go through in a couple of slides. Variable lease payments can be a little bit complicated if they're tied to an index or something like that. However, the important thing that we'll talk about in a bit is that we just want to measure those as of the date of the lease commencement. And so that shouldn't be too big of a deal if that information is made available to us. The transition and disclosures, that is going to be a little bit complicated this year. When you look at your financial statements, there's going to be a lot of new disclosures and some additions to the core statements themselves. We're going to go through all of those. And your accountants or your auditors should be helping you with that process and giving you good examples. So I wouldn't worry too much about that. And lastly, the need for software. Wegner uses LeaseCrunch to assist our clients if they so choose with entering the leases into that software and then spitting out the journal entries and some of the disclosure information. This standard can absolutely be done through calculations on an Excel spreadsheet. There's many options that you can choose from on the internet for some templates. The only thing that I'll warn is if you have a lot of leases or some complicated leases, that you really have to understand those calculations in order to use one of those templates and not potentially make a mistake that could have a significant impact on the calculations. So we'll start out by talking about what a lease is. And to just put it as most basic terms, it's the right to control a physical asset for a period of time for some payment. Specifically, the lease standard does not include those couple of items listed in the middle of the slide there. I don't think that many of the nonprofits that we're working with have leases or something like a lease for those types of items. So I don't think that that's going to be a big deal. However, we do see from time to time organizations that get a in-kind rent or a promise for multiple years of free rent, and that's specifically outside the scope of this lease standard. What I'd like to just point out on this slide, this kind of breaks out what a lease is and what the lease needs to contain. Leases can be explicit or implicit, which would be called like an embedded lease. So it's important to read your contracts that you have and see if they contain an asset that you would be in control over. This is fairly common in service contracts. So you might see these with a outsourced IT arrangements where they're providing laptops or servers or something like that. You just want to read those very carefully with your accountants or auditors. So once we've determined what a lease is, we have to talk about the lease term. So the first part of the lease term is the non-cancelable period, which is pretty straightforward. And to that, we're going to add any renewal options that you're reasonably certain to exercise. These are fairly common, particularly in space leases that, there's an option to renew for another 5 years or 3 years or something like that. We'd also add into the lease term any periods covered by a termination option if we think that we're not going to exercise those. Not quite as common, but sometimes leases will have an option for like a 5-year lease, but you can terminate after 3 years. So we would add those in if we were likely not going to exercise that termination option. And then we would add any periods to extend within the control of the lessor. We're automatically going to assume that the lessor would extend in these circumstances. And then once we have that, we know what our lease term is. And also, I'll just point out that a lease is no longer enforceable when both the lessee and lessor have the right to terminate the lease. So when both parties have that option, it's no longer a lease. So we'll go through a couple examples here on lease terms, as this is an important topic and can be a little bit confusing. In the first example, we have a non-cancelable period of 3 years with a mutual option to renew for 3 years. So what's the lease term? It's just the initial 3 years, since both the lessee and lessor have the option and have to agree to the renewal period. In our second example, we have an agreement for 48 months. The lessee has the option to extend for another 12, but they're uncertain if they'll do so. And then at the end of that, either 48 or 60-month period, the lease can continue on a month-to-month basis, and either the lessee or lessor can cancel. What's our lease term there? It's just the initial 48 months because the lessee is not certain that they're going to exercise the renewal option, and then the month-to-month option is excluded because both parties can cancel it. Another thing that I'll point out right here, and we'll talk about a little bit later, is in these situations where you have an option to extend, and initially you didn't think that you'd use that option, if there's a change in judgment down the road, you might need to reassess that the asset and liability balance and potentially do a recalculation. So now we'll cover a little bit about contracts with multiple components. So generally speaking, you would account for only the lease component in the lease calculation and the non-lease component separately. However, this can really be a difficult thing to do in practice, as leases don't always break out specific prices for what might be the leased asset and what might be a service component. So as I mentioned before, to save time and effort, nonprofits will have an option to combine the lease and non-lease components and just call that the one entire lease component, and that would make things much easier. If you were going to break apart those components and they weren't listed separately in the lease, you'd have to allocate costs on relative standalone prices and come up with some potential costs for what the asset might cost and what a service agreement might cost, and that can be very tricky and take a lot of time, and I don't think that many organizations are going to want to do that. So this is just a graphic of what we were talking about. In our example, we have a copier lease, and the lease component is just leasing the copier itself. The non-lease component would be, as we have on the side there, a service agreement where the lessor is on call 24 hours a day to make sure that the copier is working right. There's also some non-lease components like you see at the bottom, and that could be something like payments for taxes and insurance. So now we'll talk about the discount rate. This was something that I think many people were a little bit confused about as lease guidance started coming out. The discount rate is used to take the present value of the future payments that you'll make to calculate the lease liability. Sometimes in a lease, they'll explicitly say what the rate is. However, most of the time that's not the case. If the rate isn't known, an organization should use its incremental borrowing rate if it knows it. However, my understanding is that many organizations are not going to have an incremental borrowing rate readily available that they know about. So the solution is that organizations can use a risk-free discount rate. And this is really simple. And on the next slide, we're going to go over how you can look that up. So this is from the Treasury Department's website. And this is how you can determine your risk-free rate. So you can see I have the address down there in the bottom of the slide. So you go to this website here, and then you'd select from the drop-down box the daily Treasury par yield curve rates. And then on the left side, you can see the dates, and then going across the top are different periods. So what you do is you would find the date that your lease started, and then you would look as far as the years for the appropriate length of your lease and go across and find the corresponding discount rate. So it's really a simple thing to do. And I expect that many organizations are going to use this risk-free rate. So next, we're going to talk about the payment streams that are involved in leases. The first and easy part is just the fixed payments that are present under the lease. We also sometimes see that there's variable payments. And as I mentioned before, those are initially going to be measured at the commencement date for whatever that rate might be in the index. We're also going to consider probable amounts that might be owed under residual value guarantees. So think about, like, maybe if you're leasing a car and you have to have less than a certain amount of miles on the car. There's also the exercise price of purchase options if you're reasonably certain that you're going to exercise those. So again, think about a car if you're going to potentially buy the car at the fair market value at the end of the lease. And then there's also penalties for terminating the lease early if it's reasonable that you're going to exercise those options. So again, if you might end a lease after 3 years, if it's a 5-year lease, then you would add that into your payment amounts for the lease. So one thing that you might have heard a few times and we'll continue to talk about with these with the lease standard, a lot of things are contingent upon if you think it's probable or likely that the organization will make a choice, and that's just it. So if you think that you're going to do it, alert your accountant or your auditor that, we think we're going to exercise this option, and it's just basically that. It's your best guess at the time. Now we'll talk a little bit about lease materiality. So this standard does not have any exemptions for leases of small assets. So think about like your postage meter or potentially your water cooler. Those are low dollar leases, and it might be more trouble than it's worth to include these as an asset and a liability on your financial statements. So you can think about your capitalization threshold for fixed assets and how you might have a reasonable number that if your purchase is below that you would just record as an expense. Well, organizations can consider doing this for the lease standard as well. And you can, set a reasonable amount where if the total payments under the lease are underneath that threshold, you might just record those as an expense and under the old lease guidance. So like I said, a really simple thing that you can do without getting into any present value calculations would be to just multiply out the number of payments by the rate for the various years and add those all together to see if that lease in its entirety is significant to your financial statements. Now we'll talk about calculating the lease liability. So at the commencement date of the lease, the start of the lease, we want to know the present value of the lease payments that you'll have under the lease using a discount rate. As I mentioned before, you can use a tool, an Excel tool from the internet that folks put up to measure these, or you could do it in a software like we're using Lease Crunch, or if you're really handy, you can just do this in Excel yourself. There's lots of different ways to do things, but the key is that we're going to come up with one amount, which is the present value of those lease payments. And that is the start of our lease liability. From there, we then calculate the right of use asset. And the starting point for that is the lease liability itself. To that, we would add any prepaid lease payments that you might have had in a prior period. And we'd also add any direct costs. Those might be something like a legal fee that was contingent upon the lease acceptance. And then we back out any lease incentives, which might be something like a free rent period. There are three main types of leases. There's short-term, financing, and operating. So we'll talk about each one of those. And the first one that we have here is short-term leases. Those are leases with terms of 12 months or less, and they cannot have any extension possibilities. So if we have a short-term lease and we take the option to recognize these under the old accounting guidance, that would be much easier for many nonprofits and most organizations. So if you take that election, you would not have any lease liabilities or right of use assets, and you'd basically be recording these just like you had been doing in prior years. I expect that most nonprofits are going to want to do this. Next, we'll talk about finance leases. These are very similar to the old capital leases. And these criteria that are described in the graphic below are basically the same tests that you might have seen under the old capital lease guidance. I won't go through each of these. Maybe they're familiar to you. However, if not a single one of these are met, then by default, the lease will be described as an operating lease. So what we have here is just kind of showing the difference between the finance and the operating leases and how they'll show up on the various financial statements. So on the balance sheet or the statement of financial position, they're both going to show up as a right of use asset and liability. On the statement of activities for a financing lease, you're going to have two types of expenses. You're going to have an amortization expense of the asset and also an interest expense. On an operating lease, there's just going to be one expense, and it's going to be called lease expense or something like that. And then on the cash flows, again, for financing, we're going to have two types of cash flows. There's going to be an operating component, which is the interest, and a financing component, which is the cash paid for principal. This is just kind of like on a note payable if you were making a payment on the note for an asset that you might have purchased. And then on an operating lease, we're just going to have one cash flow, and that's operating cash for the lease payment. So we'll see that operating leases are going to be more typical for office spaces and longer term assets. And the finance leases are going to be more typical for equipment like copiers or technology or things like that. If you are working with your auditor, you may have already seen a document that has a number of these policy elections that I've talked about already a couple of times. But for the next few slides, I'm going to go through these policy elections that the organizations are going to have to choose. And kind of each one of these is going to have a starred option. That's the one that we think is going to be easiest for the organization to implement, just taking less time and resources. So we'd certainly encourage you to consider using those starred options for your policy elections. The first one, which we've talked about a little bit about already, is the short-term lease liability. So we're encouraging organizations to not follow the lease standard for short-term leases and just use the old guidance on those short-term leases. It's going to save you time and effort and be a little bit less confusing as far as all the disclosures that would go into getting those short-term leases on the books. I don't really plan to spend too much time on the disadvantages on these. Like I said, I don't think that there's too big of a cost for many organizations to not follow the policies that we're recommending. There's something listed on each of these, and you can certainly consider them, but I don't think it's going to be a big deal for most nonprofits. The second policy is the non-lease components. So again, we're going to recommend that you elect to combine the lease and non-lease components for all the different classes of underlying assets that you might have. This is just to really make it easier when you are looking at those kind of tricky leases where there's both a service component and a lease component, and the amounts aren't readily available. So then you're just not going to have to go through the effort of allocating prices out and making assumptions. This next policy has to do with the two definitions for economic life of the lease and the fair value of the leased asset. The election that we encourage you to follow basically says we're going to stick with the old definitions used under the capital leases, and I think that that's essentially what most organizations are going to choose. The next one that we have for the presentation of assets and liabilities, this one, you could really go either way. So we're recommending that you present the separate classes on the statement of financial position. However, some organizations are going to choose to combine those assets and liabilities with other categories that they already have. Maybe the assets are going to show up in something like property and equipment, and maybe the liability might go into something called other liability if it's relatively small compared to the balance sheet. It's fine to choose either way. The only thing that you would do if you presented those within other categories is add an extra table or note to your financial statements, and we'll look at that in a bit. The policy for the initial application of the standard is something that we'd strongly encourage folks to only present for the most current period without restating the prior period. It's just going to save you a lot of work having to do calculations for the previous year. And so we think that in most cases, organizations are just going to want to do it for the current year for 2022. And then you'll have some inconsistent reporting between the periods. But I think that most users of the financial statements are going to understand these options and why they might look different between the years and be very comfortable with them. So this little table here, I'm showing you that under that policy election where you would choose to only apply in the current year, in the right column, that would be our prior year, and we're not showing an asset or liability for our leases. In the left column, you can see that we have an asset that's slightly smaller than the liability. Now, this would be as of the first day of the year when the lease standard was implemented. And if we saw that that asset and liability weren't equal, and we see that cumulative difference that I have there of $2,000, that needs to get plugged to the net assets. And how that will show up on your statement of activities, which is the bottom portion of the table there, is a line that many of you probably haven't seen used before, and I haven't before this standard has come around. But we would put the difference to its own line called cumulative effect of change in accounting principle. And that, along with the change in net assets, will let us arrive at the net assets at the end of the year as they should be presented. Here we have some transition reliefs that you can choose between. For the first package of three, what they're basically getting at here is that you're going to carry forward any previous decisions or determinations that an organization has made. So in the past, if you looked at a contract and you decided that it was a capital lease before, you don't have to reassess that determination that you made. Now it's going to be a financing type lease. So, and previously, if you determined that a contract was an operating lease, and it's going to be an operating lease now. So it's just basically saying we're going to take the information that we had previously and the decisions that we made and roll forward with those. For the hindsight policy election in the middle, it's more work to look all the way back to day one on how, you know, an asset or liability would have been recorded at the beginning of the lease term. So we're recommending that you choose not to elect that policy. And then finally, on the bottom of the screen there, you have an option to apply one discount rate to similar assets or asset classes. We just think that, you know, it's pretty simple to go to the Treasury website and look up at a rate for any new lease that you might have. So we're recommending that you do not follow that policy election and simply pull a new discount rate whenever you're getting a new contract with a lease. Now we're going to go through just a couple of examples on some leases and the journal entries and the differences between the types of leases. So the first one we're going to look at is an operating lease. Under our assumptions, we're going to say that we have a 3-year lease, $1,000 in the first year, $1,214 in subsequent years, no renewal options, none of the confusing stuff like purchase options, incentives, or costs, and an initial asset and liability of $40,000. And this would be based on the present value of our payments of $1,214 over the 3 years. And in this case, they're saying it's an incremental borrowing rate. We could just as easily say it was a risk-free rate of 4.7152%. That funny number was used by the author of this example, as if you use that present value in the lease payments, it gets us to a nice round $40,000. So based on that information, your software or your template is going to kick out a lease amortization schedule, and it's going to look something like this. You can see some various categories that are going to be important to us, like the payment amounts, the amount that our liability is going to go down, the rent expense, and in particular on an operating lease, the rent expense is going to be the same every month. And then how our leased asset is decreasing each month. So now we'll talk about the journal entries to get that operating lease on the books. I have a snippet from our table right at the top of the screen, and that'll help with some of the journal entries that we're making. So the first thing that we're going to do is get that asset and liability on the books by debiting and crediting our liability. And then at the end of the first month, we get to record some of the activity on the lease. So the first thing that we're going to do is record that lease expense from the table above. And as I mentioned, with an operating lease, that's going to be the same for the entirety of the lease term. Next, we're going to decrease our lease liability, as you can see from the table above. Our cash payment is simply the cash that you paid. That will be different over the 3 years on this example. And finally, the plug that we have for our reduction of our asset is just the difference between those other figures we had in our journal entry. So this slide shows us how those lease entries will look over the course of our lease term. So the cash payments increase year over year as we expected. Our lease expense does not change over the term of the lease. And then our right of use asset and liability decrease over the term of the lease and get us to a zero balance at the end of the lease. Now we're going to consider a finance lease, and we're going to use the same facts as our previous example, but now we're going to pretend that one of those components was met in one of those categories was met that we discussed earlier. We could say there was a bargain purchase option. Our journal entry to get the asset and liability on the books is the same, where we're going to debit our asset and credit our liability. This is just one thing to note on this amortization table, as it'll look a little bit different on the finance type leases. Is now we're going to have a category or a column for amortization. What that's doing is it's taking the right of use asset and equally spreading it amongst the lease term. So this the amortization is going to be the same each month for a finance lease. Whereas we're talking about an operating lease, it would be the lease expense that was the same each month. So now we'll just talk through the journal entries for a finance type lease. And again, we have the snippet from the table that we just looked at to help us with our journal entries. So we will first record the amortization expense, which will decrease the right of use asset. Then we'll record our cash payment, which will decrease our lease liability. I think I'll just kind of keep going here. So now we'll just talk about the differences between the operating leases and the finance leases over the course of the lease. So what I'll point out here is first on our expenses. As I've said a couple of times already, the operating lease is going to have the same expenses over the period of the lease. A finance type lease is going to originally have higher expenses. And then if we're looking at the statement of financial position, we're going to see that the assets and liabilities are for the most part going to be fairly similar over the term of the lease. And that, there might be some variances between the asset amount and the liability amount between those two different categories. But for the most part, they're not going to be too different. This is just a little graphic to kind of bring that point home again. So our orange line is the expenses on a finance type lease, where they're going to be a little bit higher initially and lower at the end. And then our operating lease is just going to have the same expense throughout the term of the lease. What we have here is just a summary of the different types of lease disclosures that are going to be needed to be added to your financial statements. I'm not going to go through everything on this list, but instead what we'll do is we'll go through some of the examples as they might apply to your financial statements. So the first thing that we'll have is a significant accounting policy for your leases. And what we're going to be doing with this policy is we're going to describe how your leases are recorded, the types of leases that you have, where they show up on your statement of financial position, if you're using the short-term lease exemption, how your discount rate is determined, and if you're combining those lease and non-lease components. So what I did with some different highlights was to show where there might be some variability in your policies depending on the policy elections that you make. Then we'll be looking at some footnote disclosures. And with our footnotes, the first paragraph that we have is going to describe the leases that you have. the remaining terms, and any short-term costs if you have those short-term leases. And what I'll point out is that if you are only applying the lease standard to the most current year, you will need to repeat your disclosures for the prior year if you have comparative financial statements. And as we talked about before, if you do not break out your right of use asset and liabilities on the statement of financial position, you'll need to have a table like I have down below where you're showing those different categories of assets and liabilities. There's more information that we have to disclose about the costs and cash paid associated with the leases. And I took the snippets from our examples from those lease amortization schedules above and below, just to help us with where the figures are coming from. So it might make a little bit more sense. For the operating or for lease costs, those are the expenses that you have. And on our operating leases, there's just going to be one. And on our finance leases, we're going to have the amortization expense as well as the interest expense. And then we're having to disclose the cash paid, which is simply the cash outflow for the leases. And operating leases, again, we're just going to have one operating outflow. And for our finance type leases, we're going to have an operating outflow for the interest expense. And then we're going to have a financing outflow for the principal portion of the lease payment. Something that's new with these leases is that now we're going to have to disclose the weighted average remaining lease term, as well as the weighted average discount rate. And on the next slide here, we're going to talk about how those are calculated. The difference between a mean average, where you just add everything up and divide by the total number that you have, and the weighted average, specifically for these lease terms and discount rates, is that the weighted average is going to put more of an emphasis on leases that have larger liabilities and larger future payments. So for our weighted average lease term, we're going to start in column G and look at our remaining years on our leases. We're going to multiply that remaining lease term by the lease liability at the end of the reporting period. And we're going to sum those products and divide by the lease liability at the end of our reporting period. And that's going to give us what our weighted average lease term is. For the weighted average discount rate, we're going to take the discount rate on each lease that we have, and we're going to multiply that by our future payments. And then we'll take the sum of those products and divide by the future payments. And that's going to give us what our weighted average discount rate is. And the last key disclosure that we'll be looking at is a maturity of the lease liabilities. And this is somewhat similar to what we've disclosed in the past for leases, where we have the cash payments over the next several years on the lease, but it's also kind of like a note payable footnote as well. So to those cash payments that we have for the future years, we're going to deduct the amount that's imputed interest, which we saw from those lease amortization schedules. And once we back that out, the amount will agree to what we have as a lease liability at the end of the lease term. So now we're going to talk a little bit more about lease modifications. So a lease modification would result potentially from adding or removing an asset from a lease, increasing or decreasing the payment, or changing the lease term. So when a contract is modified, we have to consider, if the contract is still a lease, and if it is a lease, if it should be accounted for as a new and separate contract. And we'll talk about that just right now when we switch to this slide. So if we had a lease modification and we had some new assets that an organization received and the increase in payments because of those assets was equivalent to the standalone price, then you'd be looking at basically like a separate contract, as though somebody drew up a new contract for those assets. However, if those some different situations that wouldn't meet the criteria for a separate contract would be if you just change the term of the lease, if you fully or partially terminated the lease, changing the prices, or if you got an additional asset, but the price increase was not commensurate with the standalone price. So you got more, but you didn't really pay the full value for what that asset would be. So if we've had changes to a lease like we just talked about, we have to consider if we need to reassess the assets and liabilities. So for example, if we extended the lease term on a lease, we'd likely end up having a larger asset and liability due to having increased total payments on those leases. So it's important that if anything changes on the leases that you have, that you work with your accountant or your auditor to let them know about any modifications and share those with them so that they can help change the amortization schedules, which will then likely result in an increased asset or liability balance depending on the revision. And then just it notes down there at the bottom that you'd remeasure these assets and change your amortization schedules whenever the date of the reassessment happened. So if you are a lessor, you only get one slide in the presentation. Nothing really changes if you're a nonprofit leasing some space that you have to someone else. There's going to be no changes to your balance sheet. You're going to continue to have those assets and liabilities as they've previously been reported. And your rental income is going to continue to be recognized on the straight line basis over your lease term. It's that simple. You don't have anything to worry about with the lease standard. So a lot of folks have been asking, do I need to adopt the lease standard? And the answer is, as always in accounting, it depends, but probably is the most likely answer. So if you're required to get an audit or a review or turn in your financial statements along with your Wisconsin 1952, they require GAAP basis financial statements. So in those cases, you'd most likely be needing to adopt the lease standard. Most of the granting agencies like the county or the state are going to require you to have GAAP basis financial statements. So in those cases, you're likely going to need to implement the standard too. However, there are some organizations that don't have any requirements to have an audit or review, but they choose to do so anyway. And in those cases, you may be able to just follow the old accounting guidance. So in cases like that, if the leases, assets, and calculated liabilities would have been material to your financial statements, the audit or review reports would likely need to be modified for a GAAP departure. And the tough part about not doing something in accounting is there still are some costs to determine the effect of not applying the guidance, because in those reports, we have to disclose, potentially how much your assets and liabilities and expenses would differ if you had followed those, the new standard. At a high level, though, for all organizations, if your leases are not material to the financial statements, the auditor and client might work together to determine if a past entry can be considered. And basically, we would propose the journal entry as how those balances should be presented, and that would be shared with governance, but you would still have your financial statements without those calculations in them. And then finally, some organizations that are only filing 990s might be choosing not to adopt the lease standard at all, and are still, my understanding, is able to mark the accrual box on the first page of the 990. So now we're just going to close things out with a few slides on COVID-19 funding. The first that we're going to talk about are the EIDL loans. What I want to point out here is that the loans are subject to single audit. So if you have a schedule of expenditures of federal awards, your EIDL loans are going to go on there. And also that many of the EIDL loans began to require payments in 2022. So if you had those, you might have had to start making the payments where there was a period of 24 months where the payments were deferred. Next, we'll talk about employee retention credits. So these are not subject to single audit. And if you are applying for these credits, you have to be very careful to make sure you're not double dipping on other governmental funding that you might have received. If you have not applied for a credit, but think your organization might be eligible for one, the good news is you have plenty of time to file those amended 941s, as you can see down towards the bottom. And then I'll just point out that in the accounting industry, we've become aware that some unscrupulous organizations are claiming that they can get companies huge refunds and are also charging contingent fees for that service. So the bigger the refund, the higher the fee will be. And we just warn you to work with a reputable organization if you're considering getting services for an employee retention credit. The last type of funding that we'll talk about is the provider relief funds. These are subject to single audit. They're generally considered a conditional grant. There's been some confusion over how these funds get reported for GAAP versus how they show up on the schedule of federal expenditures of awards. The next couple graphics that I have describe how those funds should be showing up in various years and on the CFA. And I won't go into specific details on these other than to say that if you have provider relief funds, please work with your accountants and auditors, and they'll make sure to help you get those presented in the right spots. That's really at a high level all I wanted to share with you folks about the auditing standards, the accounting standards, and the COVID-19 funding. I'm happy to try and answer some questions now. If you'd like, you can certainly send me an email, or we can find a time to talk through if you have a more in-depth question. But I understand maybe some questions have come through the chat, and I'll do my best to answer those right now.
Well, there were just a couple questions in the Q&A from earlier in your presentation. Christine has asked, it appears volunteer time is not considered gift in kind, true?
Pardon me, I think that I have to try and get the volume up a little bit. I'm having just a little bit of hard time hearing you. Could you say that one more time, please?
Sure. Her question was, it appears volunteer time is not considered a gift in kind. Is that true?
That would not be correct. So if you had volunteer time for a professional service, such as donated legal services or donated accounting services or architectural or something like that, that would most likely meet the definition of an in-kind contribution. However, if it's non-specialized labor, like you just had folks coming in to maybe serve a meal or to help clean or do something like that, that would most likely not meet the definition of being recorded as a in-kind contribution.
Thank you. And a follow-up in-kind question, is board member volunteer time considered in-kind?
Most likely not.
Thank you. And the next question is, if you have a rental lease starting in January, would that be recorded on the balance sheet and statement of accounts as well for the full year and then straight lined each month?
So if I'm hearing that right, we have a new lease starting in January, and I'm not sure if the year that we're talking about is 2022 or 2023, but it really doesn't matter. If it's a multi-year lease, we're most likely going to be recording that as a right of use asset and a lease liability on the statement of financial position. And then that lease will get amortized over the lease term. And I heard about the straight line basis, and the expenses on an operating lease are going to be the same, similar to how they would have been previously on a lease that was recognized over the straight line basis. So there's going to be some similarities there. If that person maybe wants to follow up with me after the webinar today, I'd be happy to help them with that specific example. But the short answer is I believe that the lease will be on the statement of financial position as both an asset and a liability if it was entered into or continuing after the date of January 1st, 2022.
Thank you. Those were the only open questions I have at this point. If anybody else wants to throw anything in the Q&A, we can certainly have Kyle address that now. Otherwise, his contact information will be in the follow-up email I'll be sending to you, and you can certainly reach out to him after the webinar. And just a short announcement that we have some other great trainings coming up for nonprofits. We've got a QuickBooks users group this Thursday, a webinar on the new lease accounting standard next week on December 14th, and a certified nonprofit accounting professional course beginning January 12th. So be sure to visit our website at wegnercpas.com for more information and registration for any of those sessions coming up. And it looks like the person with the lease question got back to you and said if that lease is only for 1 year.
Oh, if it's a 1-year lease, you would still record the expense straight line, I think is how they say you're supposed to do it. However, in practice, if it's a 1-year lease, you really don't need to straight line it because the expense is going to be at the end of the year, if you started on day one, the same no matter what. You could follow that short-term lease guidance, and then at the end of that lease term, you would not, or even at the end of the year, you would not have an asset or a liability on your books because it would have been fully amortized down to zero.
Great. That looks like you're all caught up on questions for now. So we will close out. But like I said, if anybody has follow-up questions, feel free to reach out to Kyle directly. Thanks everybody for joining us today.
Thanks so much. It was great to be able to present to you.